how you should structure your investments according to the CFP curriculum. At the end of the day, the way you invest should be determined by three components. One is going to be your risk tolerance, the amount of risk that you can handle and the amount of money that you can stand to lose. Next is going to be your time horizon, how long until you need to pull this money out. And then finally, what are your goals? What are you trying to achieve with this money? Are you trying to maximize the growth, or can you be a little bit more conservative because you have a lower required rate of return? Generally, the higher your risk tolerance and the longer your time horizon, the higher up you can move along the risky threshold, and you can hold more of the more risky assets. This will again be up to your determination, and it takes a little bit more fine-tuning than that. But this is a really good place to start, is finding holdings in these ranges and lining it up with your needs. Let me show you how to build a diversified investment portfolio. First things first, what are we even trying to diversify away? There are two types of risk in the market. The first one is going to be market risk, and this is actually what you get paid for, so we don't have to worry about that. The next part is called unsystematic risk, and this is actually what we're trying to diversify. I'm going to break down unsystematic risk into 5 different sections. First is company risk. These are risks that are only pertinent to one company. To diversify this, you need 20, preferably more like 40 individual stocks. Next is industry risk. There are 11 industries. Own a stock from each of those industries. Next is equity risk. Don't just own stocks. Include bonds and real estate and maybe alternatives. Next is country risk. Own stocks from multiple countries and multiple continents so that one type of risk doesn't screw you. Finally, we have size risk. This has to do with risks that are only pertinent to companies of a specific size. Make sure you own some small companies, some mid, and some large. I'm going to show you how to build your investment portfolio depending on your goals and your risk tolerance. Before you even look at a stock or you consider an investment, you have to understand who you are as an investor and why you are looking to invest in the first place. Start by looking at the S&P 500 and decide for yourself, can I handle losing 50% like it did in 2008, or do I need to be more risk averse than that? Then you can measure the stocks that you're considering investing against the S&P 500. I recommend using standard deviation or beta. Next, consider your goals. Not everyone needs the absolute highest rip-roaring returns. If your goal can be achieved by earning 6% annually for the next 15 years, you should aim to hit 6% every single year instead of taking more risk. Once you have a good understanding of your goals, you have to worry about asset allocation, which is what I'll talk about next. I'm going to tell you how I determine the asset allocation for an investment management client. The first allocation question is between less risky and more risky securities. More risky being stocks and options, less risky being hedged equity investments, bonds, or commodities. We combine these to hit our client's risk target, which is usually relative to the S&P 500. Then, within the risky side of the portfolio, the stock side of the portfolio, we ask 2 questions. The first question is diversification. This includes minimizing variance, so picking some stocks that move together and other stocks that move separately, so that the overall portfolio is diversified from a risk standpoint, and then global and locational diversification. The second question is our clients' personal values. Some clients prefer to only invest in companies that focus on climate change, and so we provide them that exposure and then make reallocations on the risk side. This is the most important part. Don't hold cash. Invest it in something. This last year, we saw the highest inflation rate that we've seen since 2008, and inflation is notoriously bad for pretty much every type of investment, but especially bonds and dividend-paying stocks. So, how do you prepare your portfolio for inflationary times? The 2 mainstays that many investors flee to when inflation goes up are going to be real estate and commodities. Why? Because real estate tends to rise with inflation. Commodities do as well. In most cases, commodities are actually the ones driving inflation, so it's a good place to be. Many conservative investors will also pick up TIPS. These are inflation-protected treasury securities, and so these pay a base level of interest, and then they increase or decrease that interest based on the inflation rate, and this is adjusted every 6 months. Bond investors will reduce the duration of their portfolio when inflation comes up because interest rates will likely follow. Is inflation going to hurt your stock investments? No. But also yes. Let's get into why inflation matters. Inflation can hurt stocks, but it's going to hurt some stocks way more than it hurts others, and it will actually help certain stocks. For instance, something like Campbell soup, a consumer staple that people just have to buy regardless, might actually benefit from inflation because they can just pass those costs on to consumers. If anything, they can price more aggressively, which will help their margins. On the other hand, growth companies may underperform, so we're talking Peloton, Square, those types of companies. And the reason is because investors at this point are betting on those companies being profitable years and years in advance. So if a lot of inflation happens in those middling years, it makes that future profit less valuable. That makes the stock less valuable too. Inflation is certainly not a signal to sell. If anything, it's a really good argument for not holding US dollars.